everyone, welcome to the show. Today we've got Rob Tetrault and myself, Tania Tetrault. We're talking about the markets, we're talking about inflation, we're going to be answering some questions from our viewers today. And so I just wanted to say hi to everyone. I know that we've been talking to our clients a lot. And so why not just kind of give our thoughts as to what's going on in the markets, and that way, people kind of see what we're up to these days, and we can hopefully preemptively answer a lot of questions that we've been getting a lot, because I'd say we get a lot of the same questions all the time, right, Rob?
Oh yeah, for sure. I even cleaned my desk here for all of you guys today. Look at this. Look how clean this is. Clean desk.
I like it. I like it. Now, the other thing is we didn't even realize when we booked this, maybe I shouldn't admit this, but we didn't even realize that guess what day it is today? So people are going to recognize this day. It's not actually Black Monday, but it's the actual anniversary of Black Monday today, October 19th. So
35 years.
35. Yeah. So that's kind of crazy.
But to be fair, we were not in the business 35 years ago, right? So like I remember March 9th. Like I know that's the bottom in 2008. I know March 23rd is the bottom in 2020. I remember the flash crash. Like you remember those days because you're in the office and you're walking around, and like those are vivid days in my recollection. Black Monday, I was a kid. Like I barely remember.
Yeah, same here. But I actually spent a whole bunch of time with Dad yesterday. We were actually talking about just how different it actually was back then. We always we grew up with technology our whole lives. And so for us, you just turn on the news or you just Google and you can tell exactly what's going on in the markets. So it was just a completely different world back then. So it'd be interesting. I guess we're going to have Claude on one of these days to actually tell the real story.
Yeah. Are you trying to pass yourself off as a millennial, Tanya? You did not grow up with like an iPhone. Like, let's be clear. We had a modem. We had the internet when we were like teenagers. Like it wasn't.
We were early adopters, though. You have to admit, we were early adopters. So I'm technically Gen X, and you're technically millennial, right?
I'm right on the cusp. I think 1981 is the cusp year. So I'm, depending on the conversation, I might claim to be a millennial or I might claim to be a Gen X. Most of the time, I claim to be a Gen X.
I feel like it feels more like you're part of the Gen X, but it's tough to say. Hey,
I didn't get a cell phone until I was like 20 or whatever, right?
Yeah, I remember I actually didn't get a cell phone until I was past university and had my first job after university. Yeah, it was
like this
Nokia.
5165 or 3260. This Black Monday, for those of you that don't know, I do want to put this in perspective because it's pretty significant. In 1987, the market crashed 23% in one day. In one day, the market crashed 23%. That is what we are down the S&P 500 this year, roughly, ballpark. But that's one day. Hong Kong was down 48% or 50% or something. 18 of the top 25 economies in the world were down more than 20% in one day. So this isn't, that couldn't happen today because there's so many defense mechanisms in place to protect, there's circuit breakers, there's live information. So what happened, for those of you that want to know, is over the weekend. So so Black Monday was on Monday, obviously. The week before was a very negative week. The market was down about 10%, I think, something like that. The Thursday, Friday were very negative days. They announced a tax cut or a tax provision on the Wednesday. The Thursday was a big negative selling day. Friday was even worse. And then the Friday 6 o'clock news nationally, these Peter Mansbridge and I don't know who the US guys would have been, Jennings and whatever these guys are talking about a stock market crash. Back then, you could redeem your mutual funds at NAV for the prior day. So over the weekend, everyone redeemed their mutual funds. They got Friday's close price. And on Monday, these mutual fund companies had to sell out to give these people their cash. And there was no buying. So you ended up getting no bid. These stocks fell 30, 40, 50, 60%. And it was just a screwed up system. And I'm glad we fixed that now, but it's a crazy time.
So let's compare that. So let's put that into perspective. So 23% down one day versus if you kind of take just a big picture, zoom out here where we're at right now, that's roughly, I think S&P is down year to date, just over 20% now. I should actually take a look at my charts here, but that took
it's exactly 23 and a half, I think.
23 and a half. Okay. So, and we're now October 19th. And that's pretty much, the slide kind of started in January. So we've had like 10 months essentially of things sliding a little bit here, a little bit of a rally on one day, kind of some ups and downs. So for all those people out there who are kind of asking, well, how does this compare? And why is it, is this time different? A lot of people ask that same question. Is this time different? How often do you hear that question?
That's the question I hear the most. And by the way, we are here to take your questions. So if you're watching on YouTube, take a sec to subscribe. If you're watching on Facebook, take a sec to like, share, get us your comments, send us your questions. We will ask them on this show. That's why we're here. We're here to ask your questions. Now, a lot of our clients and fans and viewers have sent us questions ahead of time, so we will go through the questions we received. But by all means, send us your questions. Your question was, this time it's different, right?
Yeah. Yeah, the old adage, this time is different. Is it really different? And how is it different?
The most, right? We always get that question the most. And is it different this time? I mean, first off, we have a situation where the market has corrected 20, kind of peaked at 25%. Well, we get 25% correction. We've had 25% corrections in the last 70 years, let's say. We've had 9. Of those, we've had 3 bad ones that have gotten to 40%. That's 2008, that's 2000, and kind of mid-70s. And we've had another chunk that were kind of 25 to 40%, and we had a whole whack that were 20 to 25%. This correction, unfortunately, and this is my view and this is our view at Canaccord, yes, it's a little different in that it's inflation-based and that there's a war in Ukraine and that we had supply chain issues, but they're all different and yet they're all the same. Every single time what happens with the stock market is you get selling pressure begets more selling pressure, and eventually you get an emotional cycle that happens where they're selling, there's a capitulation, and then there's a rebound. So, I mean, I don't know at what level you want me to get into that, but I feel this time it's not different. You can own companies at tremendous discounts right now, and that's my view. That's what I believe.
Yeah, that's my view as well, and I would agree. I don't think we need to go into too much more detail, but I think you hit it right on the nose there in the sense that each time it's different, but the underlying mechanisms are always the same. We're still looking at supply, demand, and the underlying mechanisms are always going to be the same, even though the exact situation that might trigger, the fear or whatever it might be in the markets, that might change from year to year, right?
Yeah, I think I want to share my screen here. I was going to show you guys a couple screens. It used to be right on my dashboard, but it's no longer there. Anyways,
well, you can take a look at what you. So we can decide, while Rob is kind of looking for his stuff here, some of the charts, because we did prepare some charts here, but I'll also just give a shout out to all of our clients, as well as all of our prospective clients, or people just out there who want to get educated and learn more about this. Just a quick note to just put a question in the comments. If you have a question or you just want to say hello, just put that over in the comments. You can subscribe. Maybe you don't even want to subscribe. You just want to send a question. We'll be happy to do our best to at least give you our feel or our opinion on that. Now, of course, historical data doesn't necessarily guarantee future data, but some of these things can give us some pretty big lessons when we're actually thinking about a strategy here. So, I like this one, Rob. Why don't you go ahead and talk about this?
This is like this time it's different chart, right? And this is what I want to start with. This is a summary graph, and this is shout out to Martin Robert. He's one of our analysts at Canaccord. He's just so good. I'm so glad to know him and to have him in our corner. So this is a lot, but I'll break it down for you guys because this is the crux of our message today, and it's the crux, I think, of any prudent portfolio asset allocation. The red line here is the 3 worst stock market corrections in the last 80 years. So that is 1974, 2000, and 2008. Okay, the 3 worst corrections, down 48, 49, 56. This is the worst we've ever seen the market. The yellow lines are kind of the next four worst. This is 25 to 35%, so or 25 to 40. So 47, 62, 69, and early 80s, Black Monday. This black line is all the other bear markets between kind of 20 and 25%. That's 49, 57, 66, on and on. So we are right here today, this blue line. We've had a 25% correction. We rallied a bit, and now we're kind of back to that 25% correction. The question that people ask us, Tanya, is should I sell and wait for the market to crash, or which one is it going to be like? Let's assume, for the sake of argument, that we don't know if it's going to be worst case, which is the red line, kind of medium case, which is the yellow line, or good case, which is the black line of these bear markets. Remember, we're talking about significant market corrections.
I think it's a pretty safe assumption that we don't have a crystal ball.
We don't. But if we were to say, so very rarely is it this bad, most of the time it's this black line. So if we're here today, this black line is almost a 60% gain, 60% gain on average, the 60% gain from where we are today. This yellow line is a nice 30% gain. And this red line in about 2 years, two years and a bit, is flat. So my answer to that would be, what opportunity cost are you taking by not being long today? If you were presented with this chart and you forget about the day, forget about the time, and you were just to say one of these three things will happen, you would want to be long equities, right? You would want to make 60% or 30% or be flat in your portfolio. It's a chance you would want to take. So anyone who's saying, I want to sell now because I want to wait for this drop to happen, and then I'm going to try to get back in, there's a couple problems with that. First off, you're making the assumption that this is the red line, which I personally don't think it is, neither do our analysts. But even if it is, the second assumption is you have to be right on the selling and you have to be right on the buying, which is going to be so tough. When are you going to get back in?
You're actually doubling your market timing risk, more than doubling, because now you're risking the getting out time as well as the getting in time as well. So it's actually a riskier play in that particular case.
Whatever percentage you have in your portfolio allocated to stocks, assuming it was built with the right intentions, assuming your portfolio manager actually understood your needs and your goals, and assuming your portfolio manager knew your liquidity needs and your retirement and your risk tolerance, there's a reason that's in place, and you want to own that percentage. So if it's 40% or 60%, you want to continue to own that. And in fact, you should consider rebalancing and adding if you're below your number, because this is a time you want to be long stocks. Even if the market corrects a little bit further, you want to be long stocks. I'll stop sharing my screen.
It's pretty convincing chart. Even if that red line is your worst case scenario, it's pretty convincing. All right. So we have a question from a viewer. Thanks so much for sending a question in. Now, what is your outlook on the bond market? Sell or hold? Oh, that is something that we've been hearing about, especially now with inflation, interest rate hikes. Good question.
Yeah. So if we look at the bond market today, if I were to pull it up and look at what the bond market has done today, so just put like XBB or something like that, year to date, the bond market is down about 15%, 15% this year in 2022. Why is it down 15%? Increasing interest rates. So when you have upward pressure on interest rates, your current bond that's yielding 1 or 2% is worth dramatically less. The quick math on that, if you have a 10-year bond, for every 1% change in interest rate, you lose 1% per year of your 10-year bond. So you lose about 10% on a 10-year bond. On a 30-year bond, you're going to lose about 30%. You lose that value in a rising interest rate environment. So that's what happened this year. Now, what do we expect in the bond market? The one thing I would say about the bond market is, again, we don't really know exactly what will happen with interest rates, but the central banks have said that they will continue to push interest rates up. Why are they doing that? They want to do it to beat inflation. They want to combat inflation. They want to have fewer dollars chasing fewer goods, right? Or chasing more goods. So, they want to have fewer dollars chasing, which would bring the price pressure down. They want to encourage you to save money in the bank and earn 5 or 6% or put it in a portfolio instead of spending and instead of buying stuff, which is causing inflation. That is the central bank's policy. So our view is why take the risk in fixed income? Because yes, you're making 4 or 5% or 6% in your bonds, but what if we get another 1% rate hike? What if we get 2 more percent rate? What if we get 3% rate hike? What is that going to do to your bond portfolio? It's going to obliterate it. So you're not being compensated for the risk that you're taking. So it's okay to own a little bit of bonds, and I believe they're very valuable for liquidity. You know, they reduce volatility, provided you have the right ones. And we have some of those for our clients, very little, but we have some. But you don't want to be long Canadian government corporate bonds right now, unless you are convinced that interest rates have already peaked. I would say now is not the time to make that judgment call. It's too risky to take that call. You're not being compensated to make that call. Instead, the better way to play bonds is to wait it out into other asset classes like alternatives or anything else. And then once we have a good sentiment that interest rates have peaked, then you can actually look at locking in 5 and 10-year rates at maybe 6% or something like that. And once inflation is down and the world is back to normal, that might be a really good investment.
Good.
Sorry, that was a long answer, but I mean, this is one that's not easy.
No, and it's a great answer. And even though we can't necessarily, without knowing our viewers' exact situation, we can't necessarily give you advice without knowing what your asset allocation is and what other options you have for income, whether your portfolio is more income based, whether you're a conservative investor or higher risk investor. So of course, these are all things that you'd have to take into account. But I think Rob gave a pretty good overview of where we think things could be headed based on interest rate hikes.
Yeah, this is XBB right here. So like there's a lot of there's a lot of damage that's already happened. And even if you look at the 5-year, this is 5-year. Anyone who's owned bonds for 5 years, and I think you guys know me, those of you that have followed me, I've been on BNN, I don't know how many times saying that the day of reckoning for bonds was coming. I said it 3 years ago, 2 years ago. I said it last year. We dramatically shifted away from this. It's not been pretty, and I don't think we're done yet, which is why I would say be careful.
Yeah. All right, let's see if we have any more questions. I don't see anything coming in just yet. So since we're on the topic of interest rates, inflation, is there anything else that you wanted to talk about on that side of things? I think we might have some charts on inflation. Do we want to dive into that topic?
Sure, yeah. I mean, inflation, let's address it real quick. Inflation has been... I could get to inflation now, or should I take that question? Let's take that question.
Yeah, let's take the question. So from Kowalczyk Airdrie Real Estate Rentals. Okay, so the question is, what is your take? Will there be a major North American recession coming in late 2022 or early 2023? So I think maybe should we start by maybe defining what a recession is?
Go ahead.
Okay, so recession is simply 2 consecutive quarters where I want to say decrease, but let's see, negative GDP. So it's actually an indicator that a lot of people, when they think about the word recession, they think kind of like end of the world, maybe not end of the world, but big mess in the markets. But the reality is we're probably already in there. But what would you like to add to that, Rob?
Well, I think the technical definition of a recession is kind of what matters for economists, but for real Canadians, what matters is your impact on, the impact of the recession on you, let's put it that way. So the impact of the recession on your portfolio, first off, let me address the recession piece. We will be in a recession at some point in 23. It's going to happen. I don't want to say unequivocally, but like there's going to be negative GDP growth. There's going to be 2 consecutive quarters of negative GDP growth. That doesn't necessarily mean that, this is the key, that doesn't necessarily mean that the stock market is going to react to that, because as you probably know, and Tania, you for sure know, is the market is a reflection of today's emotions with respect to human beings. Every person on the planet is either buying or selling stocks, and they are a reflection of what they think will happen in the future. Institutions, pension funds, you name it. If there are more people buying, it goes up. If there are more people selling, it goes down. Today, people are obviously aware that a recession is happening. If I'm saying it, 100% it's going to happen. BNN is saying it. CNBC is saying it. Bloomberg is saying it. That means we, as a market, know that a recession is coming. Therefore, The reason you see stock market corrections historically 6 months, 9 months, 12 months before the recession happens is because the market price is in before it happens. So we know it's coming. The market has already sold stocks. We are in the impacts of the recession today, even though we're not in a recession technically. So the recession will happen in 6 months or 9 months or whenever it happens. But when it happens, usually historically, the stock market has already recovered by the time you're actually in the recession, because you could see the light at the end of the tunnel, right? By then, in 6, 9 months, corporate earnings will be much stronger, inflation will be under control, and there'll be a much better mood with respect to the future. Remember, the stock market looks towards the future. So are we going to see a recession? I think yes. Are we in one now? Not technically, but it's coming, but we're certainly feeling the impacts of it. Second question for you, second part to that question for you, the investor at home who's thinking of, how do I react to this? We're going to be in a recession. What do I do? Well, your portfolio has already suffered the impacts of the recession. So it would be foolish now to take action on the basis of a potential future recession, as we talked about earlier, because the damage has already been done to the market. So hopefully that answers your question. Tania, do you think I answered that question?
Yeah, I think you did. And that's a great point. And I think that also kind of illustrates that most of the time when we, as investors, it's very hard not to react to everything that, you're hearing on the news. But a lot of the time, it is essentially too late to try to react because by the time you're hearing about it, all of this on the news, it's already being priced into the market. So that's kind of another question that we get a lot. Someone might ask us, for example, well, shouldn't we wait till the markets recover before we invest, or should we do the opposite? Should we wait until we hit the bottom, or all of these kinds of questions? And so I think that does a good job of illustrating that the market really is the ensemble of the current sentiment, or the mood, essentially, which is already taking into account what we think is going to happen.
Yeah, and the next question, the follow-up question to that Kowalchuk Airdrie Real Estate Rentals might ask would be, okay, well, what have you guys done then to kind of prepare us for this recession, or to protect us from this recession, right? Like, okay, like, why am I paying you this money to invest my money if you didn't go all cash, or you didn't sell all my, like, what did you guys do? And I think for that, I don't know if you want to address that question, or if I'm asking myself a question, but
I can actually start on that, because I think what's important for us is our approach essentially is to have the appropriate asset allocation regardless of what the market conditions are, regardless of whether we're in a bull market or bear market, regardless of whether we're in a recession. So when we build a portfolio, we're building a portfolio knowing that, eventually we will have a recession. And so how can we have enough capital preservation? How can we work on reducing volatility so that our clients feel comfortable and they can, sleep better at night, knowing that we're already taking this into account, building out the portfolio? So that's my high level answer, but I'm sure you might have some technical details to add to that.
No, I think it's great. And I mean, for anyone who's followed what we've said, and I'll share my screen again here, anyone who's followed what we've said knows that we're a believer in we kind of prepared for this years ago. And how have we done this? Well, 10, 12 years ago, when I started this business, I knew that every 4 years we would go through some sort of cycle like this, where we might be down 15, we might be down 20, we might be down 25%. And I said, how do we minimize the damage that's going to do to clients' portfolios? This is the picture right here. It's called the Vanguard Balanced ETF portfolio. This, if you're a Canadian and if you're at an investment institution not with us, this is probably how you're doing this year. Something like this, a balanced ETF portfolio. You're down 16.44%. And unfortunately, that's what most Canadians are feeling this year. For us, the answer has always been allocating to investments that generate returns regardless what happens in the stock market. We have a portion of our clients' assets that are dedicated to private real estate, multifamily housing, private infrastructure, private equity, farmland, music royalties, private debt. All of those pieces, all of them, are positive this year. Most of them are around 10%, some are 12, some are 8. But that is generating positive returns in a year where the stock markets are not. So we did this. We went overweight alternatives in our portfolio in the last 2 years because we wanted to protect capital. We wanted to reduce. So when a client asks me, what have you done for me? Well, I say we're beating the benchmark this year by 10%. We're beating your benchmark by 10% this year. That means if you have $1 million account, we've saved you $100,000 on the downswing. If it's a $5 million account, it's a lot more. So like that's the value add that we've done, not because we're doing it today, not because we're panicking and we're making trades today, because we did it a year ago or 6 months ago or 2 years ago. And that's what we believe in. So I've been a long anti 60-40 portfolio for a very long time. And anyone who they're sick of hearing me say it, but it's not the right thing for Canadians. And like if you pull up the largest mutual funds in Canada, the largest funds at the largest banks, the big blue one with the lion, that largest mutual fund in the country is down 16% year to date. It's a $45 billion fund. It's the one fund, Tania, that you and I see all the time when we do meetings. We meet a lot of people, and the RBC Balance Fund, it's down, what did I say, 15.9% this year. So that's what Canadian owns. We did the move, so I don't know if that answered the question, but I see sorry, go ahead.
Oh, we have a new question coming in here. This one's from Instagram, actually, from Robert. Oh, Robert's in a little bit of a pickle here. His retirement fund with work has been tanking. So his question is, should I stop investing with them and do my own? Just do a self-directed investment.
So first question I would ask you is to consider is, are they matching some sort of component to that? And if they are, then you definitely want to take advantage of that matching. Obviously, if you're putting 4%, they're putting 4%, you want that free money. Second of all, I would look at, can you control your asset allocation with your fund? Usually, whether it's with Manulife or Sun Life or one of these larger fund managers, you can actually control your asset allocation in there. I would look at what you own in there. You probably have a balanced portfolio or one of these retirement portfolios. So you're getting killed on the fixed income this year and you're getting killed on the stocks. So you're down 15%. Like most Canadians. And I would look at changing your asset allocation. So maybe they allow you to have alternatives, maybe less fixed income, more stock dividend pairs. I don't know what your options are, but I would look at that. And third of all, I would look at the overall asset allocation. It might not be right for you, depending on your risk tolerance, because generally these are vanilla funds that are, it might be like retirement 2033. So, if you're retiring in 2023, you get that fund, regardless if you're able to withstand more volatility or you're able to withstand less volatility, you get the same fund as everyone in your firm and everyone in Canada that's retiring in that year. So I have some issues. I mean, they do a good job of vanilla, of making the process simple, but you're definitely not going to outperform. So if you can transfer those funds out to your personal RSP, I would definitely do that. If they're not matching and there's no benefit, if it's just coming off your payroll deduction, that's the only advantage. You could look at making a monthly contribution to your RSP or TFSA elsewhere or on your own or in a discount brokerage or with us. But there's a lot of what I would do if I were you there. So I would start there. Are they matching? What's my asset allocation? Can I change the funds? Can I transfer out? And should I even be there at all?
Yeah, great point. Sometimes there's no choice. Sometimes it's a work plan with a pension that you don't have the choice. But it's unfortunate when investors feel like they don't have control over the situation, and that's where having a good working relationship where you're communicating with your advisor, that goes such a long way towards reducing the amount of stress that investors will feel. If you can feel like you have someone that you can actually talk to about these things, it's super helpful. All right. So now why don't we go back to inflation? Because we just started talking about this. I think we've got a couple of charts, right?
Yeah. So people ask me all the time, what's inflation? So inflation is the increase in the cost of a basket of goods or services from year to year. It's measured in a year over year. Sometimes they do it month over month, generally measured in year over year. It's defined as a percentage. So if a basket of goods cost $100 last year and it costs $105 this year, that is 5% inflation. It also, more importantly, measures the erosion of the purchasing power of your loonie. So if you used to be able to buy a $1 worth of goods with your dollar, and there's 5% inflation, you're now only able to buy 95 cents roughly of goods with that same dollar. Your dollar is worth 5% less. So it's the erosion of your purchasing power of your dollar. Your dollar doesn't go as far in higher inflation. So
I think that's a great explanation. I'm just going to interrupt you for a quick second here because I think it's a good time to just remind our viewers that how this comes about is essentially too many dollars chasing too few goods. Okay, so when you have too many dollars chasing too few goods, all of a sudden your dollar just doesn't get you as far anymore because you can't get those goods because there's not enough goods and too many dollars chasing them. All right, sorry to interrupt.
No, this was very good. Like the best way to describe it is too many dollars too good. So this is a chart right here. What's been the driver of inflation since January 2018? I got some other charts on the side that I might pull up, but for now, gasoline. This green chart has been the gasoline chart, so it's coming back down. Energy. This is the cost that you are paying to heat your home or businesses. Food has been a big one. It's up 20% in the last 4 years roughly. Shelter is also up about 20%, health and personal care, and then clothing and footwear is kind of lagging. The point that I'm trying to make is that not all of these act at the same time. So the last inflation reading came in at 6.5%, something like that. It was this morning. It was slightly more than anticipated. And the reason is because some of these other, so energy came down, gasoline prices were down, I think, 10 or 8% or something like that. But the other ones were up more than expected. Groceries were up more than expected. The reason I'm mentioning this is that the inflation driver is not always going to be the same thing. Commodities typically drive inflation, but in this case, there's other things that are driving inflation as well. The path that the central bank is taking to fight inflation is going to win. So I don't know how hard they have to battle, but they will not lose this battle against inflation. I feel extremely confident about that. They're not going to stop. They're going to continue to just get there until they beat inflation. So that means more interest rate hikes if needed. Remember though that they take about 6 to 9 months to see themselves out in the economy, in the market numbers. So the moves that they were making 6-9 months ago are only being felt now. That's why you get this lagging effect, because it takes a while to turn this Titanic, to turn this boat, which is monetary policy to reduce inflation. So the one thing they have to be careful of, the central banks, is too much too soon, right? If they just pedal to the metal, they've increased it by 300 basis points over the last 6 months. There's another interest rate hike coming in December, potentially another one in January, February. So now we're going to start, in my mind, we're going to start seeing it come down, and then they're going to decide, have we done enough? Do we need to do more? But they will not stop till inflation's under control. I promise you that.
Right. And I would imagine that some of the different drivers of inflation will be affected in a shorter period of time versus some in a longer time. Like maybe, shelter maybe might take a while for things to catch up, essentially, right? And then it might be different depending on whether we're looking at energy, food, all of these things that might take a different amount of time for those to kind of correct as the interest rates get hiked.
This is a great lead into like shelter housing. So shelter housing is the largest component in CPI. It's approximately more than a third of it. So if you're worried about rent inflation, and some of you are for sure worried about rent inflation because you're paying rent, and if there's no rent control, you're paying 10% more than you paid last year, something like that. This chart shows, so it's a leading indicator in the CPI version, and it's lagged 6 months. So this is kind of showing us that we're almost at the end of rent inflation. If this, this is a highly correlated chart, and it's two indices that are, one's lagged 6 months, and you're seeing that we're going to hit the end of rent inflation here at some point. Now, I would maybe quick lead in as to why that matters for any individual. Like, we believe that owning the other side of the inflation trade makes sense. So when we own multifamily housing, the reason our alts are doing so good this year, the reason our multifamily housing is doing so good, is because rent inflation is an increase in NOI, net operating income. And when you have a higher net operating income, your property value increases, right? You have more cash flow, therefore your multiple is higher. So the alts that we own, multifamily alternative assets that we own, have done really, really well. So it's a way to hedge against inflation through our portfolios.
Yeah. which is one of the reasons why the asset allocation is so important. All right, we've got a question from Larry Archer. So the question is, how is the current threat of a sovereign debt crisis going to affect the markets?
So I think the fear about like sovereign debt, you're thinking of like potential bankruptcies of some large governments. That's not going to happen in my view. Like you're not going to see default by the U.S. or by Canada on debt, on their debt. It's just not going to happen in my mind, in my opinion. But what you're seeing now is the change in the T-bills, the rate of the T-bills, is a reflection of the higher debt to GDP ratio of the Canadian consumers, and therefore a riskier asset class, right? The likelihood of Canada defaulting on its debt to me is pretty much zero. So if it's zero, then why are we, it used to be 0, 0, 0. It used to be 0.0 with 1,000 zeros. And now maybe it's 0.
No, there's one less zero in there after the decimal.
So that's why you're seeing, one of the reasons why you're seeing those T-bills go up, the yield go up, because it's riskier asset class. But it's a similar question to the bond market question, in that I don't want to play this game where I'm owning an asset that might be worth 10% less in 3 months. It's supposed to be a safe asset, these bonds, and yet it might be worth 10% less in 3 months just because the central bank decided to load up on inflation. So like, I don't want to touch that. Like I want to be careful, very, very careful what fixed income I own. And down the line, maybe we get back into bonds when inflation's under control and the central banks are no longer freaking out.
I don't know if Larry's also asking in the second part of his question, maybe whether this affects the equities markets. I don't know if that's the second part of the question or not. I don't know.
Yeah, I mean, if equity markets in countries that have true debt crises, like Russia, for example, Russia defaulted on their debt, and look what happened to their equity market, right? The equity markets got hammered not because those specific Russian companies are going to generate. Let me rephrase that. Part of that is because the Russian companies are going to generate less cash, but mostly it's by association. You're associated with a government that's going to fail and has failed on paying its bonds. We don't want to own you. You're out. You're in the penalty box. We don't want to touch you. We're not buying Russian stocks. Therefore, that's happening. And that has happened historically everywhere. When you have economies that are failing, nobody wants to touch their stocks with a 10-foot pole. So why are the US, Canada, Australia, why are those markets historically havens for foreign investment? There's a fear that it's never going to happen. There's a sentiment that it's never going to happen here. And Larry, if you think it's going to happen there, I guess I would respectfully disagree with you. There's a risk, but I don't think it's happening.
All right. Oh, we have another one already. All right. Next question. So question is from 90-day onboarding plan. Not sure who that is, but I need to buy some US dollars between now and March 2023. Any thoughts on the exchange outlook for the fourth quarter of this year and for first quarter of next year, 2023?
Okay, so the US dollar is currently trading right around 72.5, something like that is what I have, Tanya, on my screen. So yep. It's come down quite a bit, 137.91 on the CAD side. So it's come down quite a bit. So I used to say, and I have said this many times, that there was a ceiling at 80, 81, 82 cents because Canada's in a fiscal deficit and it's in a trade deficit. When Canada has historically been in those two positions, there's weakness on the Canadian currency, lagged by about a year or two. And I said this a year or two, 3 years ago. And the US dollar obviously is appreciating as a safe haven. So I don't know what's going to happen between now and March. That's too much of a short window. I would ask you, what risks are you taking by not converting? Is your cash flow safe? If you're in a position where you can do it now, but you might not be able to, I wouldn't chase the price that you're looking for if today puts you in a comfortable spot. I mean, you need to buy some USD. Yeah, okay. So you're regretting kind of not doing it at 78, 77 cents. I wouldn't chase because you could see more downward pressure here on the Canadian dollar if we continue to see oil prices struggle, equity struggle, that is a very good situation for the US dollar. It becomes a safe haven. But when this market recovers, whenever that happens, commodities are likely going to, oil is potentially going to recover as well. And you're probably going to see Canadian dollar appreciate and money flow out of USD and into markets, into the capital market. Not really an answer you wanted, but look at your risk, and I wouldn't chase if I were you.
Another it depends answer. All right. So we've got another question here. So this one is asking whether we have adjusted portfolios in any way in the past couple of years to account for the inflation that we may see for many years to come to provide more income, and if so, how?
Do you want me to do it? Do you want to do it? I can do
No,
it.
I'm going to let you answer that because I'm still rereading it again. I'm actually going to repeat it again one more time. Have you adjusted portfolios in any way in the past couple of years to account for the inflation we may see for many years to come to provide more income? Okay, so for example, for clients who might be retired and looking for income. So I'll let you take this one, Rob.
Yeah, so our job is always to generate the best risk-adjusted returns. We want to protect against risks that exist, and there are many risks that exist. There's stock risk, there's interest rate risk, and there's inflation risk. Inflation risk for a retiree is the risk that your dollar doesn't purchase what you need it to purchase in a year from now. So it's kind of like an opportunity cost erosion. So we have to be thinking about this at all times. So what have we done? I talked about it earlier, but we like to own certain sectors in our stock portfolio. That is a good hedge for inflation so that they're able to pass on the increase in cost to the consumer. Home Depot, Walmart, some of those, Microsoft, Apple, Google, Amazon, if their costs go up, they're obviously going to make you pay for it. So you're paying more for those goods. They're a good hedge for inflation. Additional good hedges for inflation. Obviously, I've mentioned before, but pretty much all of the alternative asset classes are phenomenal hedges. Any real asset is a really good hedge for inflation. Why? I've mentioned before, but net OI goes up, net operating income goes up in inflation. Rent costs go up. Use of infrastructure goes up. Higher cash flow means higher value of your good or your asset. Therefore, value goes up. Farmland is an unbelievable asset class to own in inflationary periods. So yes, we think about this. We structure portfolios. We're not going to chase yield just because there's more inflation. We are prudently managing your portfolio, whether we make the gains from interest income, from dividends, from return of capital, or from capital gain. For us, I don't want to say we're indifferent because there's a tax situation, but we're really looking at the total return the portfolio is going to generate and doing it with the least amount of volatility, the least amount of risk.
Yeah. All right. Great answer there. All right. Oh, already the questions are rolling in. I love this. Thanks so much, everyone, for sending in your questions. This is fantastic. Let's keep the ball rolling here. So, question from Celia: should I get some GICs instead of sitting on cash?
So I want to be careful what kind of advice to give you here because I don't know your situation, Celia. But if you'd like to book a no obligation consultation to chat with this or anything else that's on your mind, go to www.speaktorob.com. www.speaktotania.com.
Yep.
Book a no obligation consultation. You can chat with either one of us to address this. But I'll give you big picture stuff.
Yep.
If this piece of your portfolio is supposed to be cash for whatever reason, because it needs to be liquid, or I think that would be the only reason you should own cash. Then I would say look at an alternative to GICs. Plus, you would need a cashable GIC. We don't believe in sitting on cash largely. We believe in being largely fully invested. Why? Because we don't know where the bottom is, so we might as well get as much possible return as we can for each asset class. So for stocks, if we're supposed to be at 40% stocks and we're at 35, we're not going to sit on 5% cash. We're going to buy today because we want to be long. For alternatives, we're completely agnostic and indifferent to what the market is doing. So we always want to have that cash invested. And for fixed income, instead of getting a GIC, which is locked in typically for 3 or 5 years, completely taxable, and you don't have control over your liquidity, why not invest in a short-term fixed income instrument or a private debt instrument that's going to yield you 5 or 6 or 7% instead of 3 or 4%? So I'm not a believer in GICs today, right now. I would look at other investments. Now, there will be a time when it might make sense to lock in a portion of your assets in term deposits, but that's not today, in my opinion.
And another good thing to know, Celia, obviously, we don't know your whole situation, so we can't give you kind of any, exact, advice on that particular case. But this actually comes back to our discussion on inflation. Anytime that you have any part of your portfolio that is sitting in cash, what you have to remember in a time like this is that it's actually losing purchasing power every day that it's sitting there, especially when inflation is higher. So that's just something to keep in mind.
And you want to have a portion in high inflationary periods. You want to have a portion of your portfolio invested in stocks. You want to have a portion invested in real assets, because those are going to. So if inflation's 10% in theory, those stocks are going to be able to capture that and generate a real rate of return above that. So in theory, you should make 20 or whatever.
Yeah, assuming these companies are well managed and that they're able to pass along the costs in a way that makes sense for them and to be profitable, which is their goal. So you've got to imagine that any well-managed company will be able to figure that out. All right. Oh, the questions are still rolling in. So next question, how have you structured portfolios or changed them in the last couple of years to account for the weak Canadian dollar and protect our ability to travel to the USA and abroad? Could we see a 50% Canadian dollar to US dollar or 50 cent?
No, 50 cent. We're not going to see a 50 cent Canadian to US dollar. That's not going to happen. I think your worst case scenario for the Canadian dollar, you'd have to be in a very, very, very expansive socialist government that was very, very, very pro-spending, not concerned about debt, significantly more than they are now. And you could potentially see, many years of this, you might see the dollar and weakened oil and gas prices. You might see the dollar trade down to 65 or something like that. Would be an absolute worst case in my scenario, 63, 64. I don't think we're going to see that. I think this range is long-term bound, 70 to 82. I think that's a range long-term. And I mentioned it earlier, but fiscal deficit, trade deficit, so that pushes down. How have we structured our portfolios the last couple of years? So depending on the client, depending on the situation, we have bought assets in USD. So we would buy stocks in USD when the stock was at 80 or 78, when the USD was at 80, 78, 82. We actually converted for some clients Canadian to US dollars. And that means you're owning Google or Microsoft in USD in your USD account, so that when the market moves like this on the Canadian currency, you end up just getting the bump from the currency in the portfolio.
Right.
Again, not everyone gets the same strategy because we create custom portfolios.
Okay, we have another question from Michael. What about keeping cash in an emergency fund?
Yes, so absolutely, you should have an emergency fund. And to be clear, when I'm talking about cash in a portfolio, I'm looking at your investable assets for your portfolio. Your emergency fund is not an investable asset. Your emergency fund is what it is. It's an emergency fund that should sit probably in a high cash performer or a cash flow GIC or something like that. And it should not be more than, it could be like 3 months roughly of your expenses, or maybe a little bit more. So I believe in that. I think that's a good idea, and that you should continue to have. Or you should have some liquidity in your portfolio that's equivalent to that. That's what I advise most of our clients to do. So in your non-registered, in your TFSA, have a portion of that is your emergency fund, but it's part of your portfolio. So I'm fine with both. To have it as cash is a little conservative. It's a little defensive. It's costing you dollars every year to do that because there's an opportunity cost. The better way is to do it through your portfolio manager. Let them know your purposes, your needs, and then they built it into the portfolio.
Yeah, thanks for the kind words there, Michael. You just mentioned that you're happy you've got someone like us doing this for you. And that you bring in a good point, Rob, that really sometimes this discussion doesn't just come down to, amount of cash that you want on hand, but also liquidity. And that's an important conversation that I think everyone should have with their advisor is, what do they feel comfortable with? Everyone has a kind of sweet spot for knowing that, hey, they could just call up their advisor and have a certain amount of cash available to them at any given time, whether that's for emergency fund, for a travel fund, or whatever that is. So I would encourage our viewers out there to make sure you're having that discussion.
When you're managing assets, for us, a big piece of managing your assets is managing liquidity. Liquidity means being able to convert assets to cash. Do you know your liquidity picture? I don't know. All of our clients, we know the liquidity picture of all of our clients. We can convert X overnight. We can convert X in 2 days, and we can convert X in 30 days. And we know the entire liquidity picture for all of our clients. Therefore, they never have to worry about not having this emergency fund. And it's something we discuss, we put it in writing, we talk to them about it. So do you know your liquidity picture would be my question that I would ask.
Yeah. All right. Oh my goodness. Now, okay, we're getting the big questions here. What if a nuclear event occurred? Well, that might be beyond our scope. I don't know.
So remember, when we look at the performance of the S&P 500 over the last 100 years, 150 years, when we talk about double-digit average returns for the stock market, we are looking at 2 global world wars. And I would kind of consider a nuclear event, I guess, as the start of a potential third world war. So if a nuclear event happens, so I guess Russia or North Korea or someone drops a nuke, I guess on Ukraine or on someone, and that would escalate the diplomatic relations for sure. U.S. would get involved. There'd be the G7, G8 would have to kind of get together and threaten and then actually impose sanctions and then probably get involved with military. Obviously, that's not good. It's good short term because it's a ton of spending, right? So spending leads to prosperous economies, leads to jobs, leads to, but it's spending for kind of GDP that disappears, right? It's not like spending for future GDP growth. So I guess it would suck for us to go through a global third world war. It would suck for those people that are dead. It would suck for the countries that are being attacked and invaded. For the purpose of the stock market, unfortunately, it would be an event that we would just deal with like we've always dealt with, and companies are going to continue to be profitable. Capitalism works. There would be companies that would exploit and profit.
And there's generally post-war booms after these things happen.
So we've gone through multiple wars, and it wasn't that bad when we went through them. It'll be fine if there's a nuclear event for your stock market portfolio. It would suck, honestly, if it happened. It would suck, but portfolios are going to be fine.
Assuming the whole world doesn't blow up, then
yeah. I just want to touch on this real quick. So that question and the questions we're getting, and I'm going to share a screen here, brings me to this negative sentiment that we are seeing and feeling right now. The negative sentiment is among the strongest negative sentiment that we've ever seen. So if you look at October 22 here, the market is more negative right now than it was in April 2020, in October 16, in June, in 08, in March. The only time it was worse than this in the last 30 years is the peak of the tech bubble in July 2000, March 2001. So there is significant negative sentiment right now. And if you look at every one of these red dots, these are all pretty much the bottoms of all of these market cycles. You guys remember April 20, that was COVID. That was like we had a 40% rally. You guys might not remember October 2016, but it was a nice rally. June 2012, big rally after that. December 08, that was not fun. Like I was doing my MBA at the time. It was not fun. These are all the bottoms, all of these things here. And we are at comparable levels for market sentiment. This is JP Morgan survey, a combination of a bunch of surveys for that. So this is an optimistic sign that I would say. Remember that the stock market's a reflection of everyone's opinions. If there are more people that are negative about the future of the stock market, that means more selling. That means down markets. That's what we're seeing right now. Historically, the markets rally a ton off of these. So it gives us a ton of reason to be optimistic. And it's why I want to continue to own high quality stocks that are growing their earnings every year, have solid management, and have a proven record of generating profits.
Okay, we've got another question. Now they're really rolling in. All right, question from Joshua. What is the relationship between inflation, interest rates, and their impact on overall returns in a well-balanced portfolio?
Okay, so inflation and interest rates, I'll try to explain that one quickly. Inflation goes up, it's more dollars chasing fewer goods. So if you have an influx of capital, the government, not the central banks, the government is either printing money or they're giving money out as like CERB payments or they're giving you checks or they're buying bonds. Those are all quantitative easing or spending. And whenever you have spending, that means more dollars in the system, more dollars chasing fewer goods, you get inflation. Okay, so that's what's happening right now, inflation. Interest rate is the central bank's job. They're monitoring and setting the overnight lending rate to control the monetary policy and the fiscal policy of the country. When they control the policy, they are trying to tame inflation. By increasing interest rates, they are encouraging people to save, to put their money in the bank, to reduce the number of dollars that are out there buying product. So interest rates go up, inflation goes down, it works. It's proven, it'll work. Impact on the overall return in a well-balanced portfolio. I mean, that's a very loaded question, but I'll do my best here. So rising interest rates are terrible for a balanced, traditional balanced portfolio because of the bonds. The bonds get hammered. Inflation, if you're looking at real rate of return, inflation should be somewhat neutral. But if you're looking at the absolute rate of return, it should increase, right? Because you're capturing some of that inflation in the returns of the stocks. I think the key here, to answer your question, is I believe, I'm biased, but that's why I'm here. That's why we've won all the awards, is our strategy works. It's been proven. We outperformed in a rising rate environment this year by 10%. Last year, stock markets were on fire. We outperformed by 6%. And I think our model has been proven. We've been doing this for a long time. We've gone through enough cycles to know that you need to own certain percentage of your assets that are uncorrelated to the market, that are hedged against inflation, and that are going to generate returns regardless. So hopefully that's what I believe should be a well-balanced portfolio. A well-balanced portfolio is not 60-40. That's not a well-balanced portfolio. We've seen it this year.
Yeah, for sure. Rising interest rates and inflation will have a lot more impact on a traditional balanced portfolio that has traditional fixed income for it. Hence our strategy to be able to handle that and deal with that with asset classes that aren't correlated to the market. Because the problem, of course, for a lot of people right now who are in traditional balanced portfolios is, of course, that the bonds are also correlated to the equities, and now there's nowhere to hide, essentially, from this correction. So
I want to show two more quick slides. I got a question. I got an email on this morning. This is cyclical and this is for real. So this is if you look at the 4-year cycle of elections in the US and what typically happens, you will see that the days after the midterm, right here, that's coming up in a couple of weeks, I think, in the US. Or sorry, where are we right now? October. Anyways, the days after the midterms are significantly positive. Okay, so this is for real, and this is seasonal composite midterm election year. We are right here in red. Historically, the next 6 months are really positive. Historically, 8.5%. There's a reason why this happens. Spending, promises, jobs, all that fun stuff spurs the economy, reducing taxes for corporations. This is all stuff that governments do to try to gain votes. And then they're doing this and the market reacts. So it's another reason to be optimistic. And my dad always has said my whole life, you buy when it snows and you sell when it goes. We're getting to that point now where historically the market crashes happen in October. I believe 9 of the last 15 market cycles have bottomed in October. I don't know if we saw the bottom, and I don't know if it was last week or if it's next week or if it's coming, but there's a good chance, there's certainly a chance that was the bottom and that we're going to recover. And if we don't, if that wasn't the bottom, if we see another 5 or 10 or 15% down, it's okay because we will bounce out of this like we always do. So assuming that was the bottom, you're kind of laughing, you've had a lot of pain. And if it's not, that's okay. If you have a nice balanced portfolio, some alts, some income-bearing instruments, some dividend payers, that's holding you up, propping you up, and eventually you'll get that rally. So don't forget about these mid-term election year cycles.
I like that chart. Yeah, it's nice to see that, to look at those historical data. Let's see if we have any more questions. Does anyone out there have anything else that they'd like us to address today?
That's already been an hour, eh? Wow.
I know, I can't believe it. Did you have something else on your end, Rob? Because I know we had a whole pile of charts to go over today.
I'll do one more and then I'll stop because we want to reach this time. It's this earnings chart, and I'll be very brief. The preseason cut to the Q3 estimates is one of the largest. So in other words, the market is anticipating really bad earnings. Okay, the market's expecting that this is going to be really bad, one of the worst. And what happens when you get okay earnings? When you're expecting really, really bad earnings? It's kind of like when I was a teenager and my parents would expect me home at midnight, but they kind of, they'd set the curfew, but they kind of they kind of knew I'd be home much later than that. So if I showed up at midnight, I was like, wow, like I was a hero, right? So if these companies are able to just kind of, meet earnings expectations, they're going to get a significant bump. And we've seen the bank earnings in the U.S. We've seen some of the consumers in the U.S. Tech, Netflix reported earnings yesterday. It was really solid. So this might be the catalyst to move this market forward. And if it's not, again, don't despair, don't be despondent. It will recover at some point, but earnings could very well lead us out of this market.
Yeah, it's been generally a pattern that we've been seeing that, we kind of are expecting the worst, and you're looking at all these earnings, and, these companies are almost as profitable, let's say, as they've always been, and growing almost as quickly as they always have been. So it's encouraging.
I saw a note on Microsoft. They're like, oh, we're only expecting, I think it was 10 or 11% growth year over year for the next quarter. And that was like, whoa, Microsoft, oh my God, it's a disaster. And I was like, really? Like that company is going to grow their earnings year over year by 10%. Usually they do 20%. I get it. Usually it's 20. But you're going through a recession, you're going to do 10. That's okay, right?
Yeah, they're not going bankrupt anytime soon.
If you own the company, that your real cash flow, like a plumbing company or a painting company, and your real cash flow was up 10% year over year through a recession, through the worst period, you'd be pretty pumped to own that company, right? And yet these stocks are being sold massively right now.
Yeah, that puts things into perspective. I think it's important to think about those things when you're hearing all this doom and gloom on the TV. Thanks for the comments, everyone. Okay, so it looks like they want us to go, Rob. It sounds like.
All right. I haven't had lunch yet, so I'll go eat.
All right. Well, thanks so much, everyone, for tuning in. Make sure that, yes, this will be available later on. So for those of you who want to listen to this and who couldn't come in, we'll put this on the YouTube channel.
And subscribe.
Yeah.
All that stuff. Yeah.
Yeah, Rob knows what to say. Is it like and subscribe? Like, subscribe, comment.
I gotta get to 5,000 followers on my YouTube page. So I think I'm like 100 followers short. So maybe you guys can help me push to get to 5,000. Help me out, guys.
Yeah, if you guys like this video, send it to your friends too, and maybe they'll want to look at it as well.
And if you're out there and you have a balanced portfolio, you're at a big Canadian bank or you're at a big Canadian institution, and you haven't really heard from your advisor, you're like, I think I might have a balanced portfolio. Take a look and give us a call. I mean, now is the time to be reviewing this because interest rates have not done going up. There's a big way to protect capital right now and take advantage of this market on the upswing. We'd love to
give us a call. We'd be happy to take a look at it for you and see what we can do to help you out.
Thanks, guys.
All right. Have a great afternoon, everyone.